Hey, you want to hear, so I'm testing the joke that I may give to Eric tomorrow, or on the podcast thing. You want to hear the joke? Let's see if it's Eric approved, because he doesn't get a joke, man. He's hard to...
Yeah.
So I was just going to say, whatever he tells, dumb joke he says, I'm just going to say, hey, you notice there's a lot of homeless people around lately? Yeah. They got dogs. I noticed a lot of homeless people got dogs. Man, they investing in the wrong type of roof.
Oh, boy.
And then I told my wife that, and my wife goes, yeah, well, they do have it rough.
Oh.
Hey, welcome to the Closing Beat, everybody. Happy Tuesday out there. I try to find these jokes for Eric that are a little edgy, you know what I mean? For Eric, he's just clean cut, super nice and everything. But I try to have a joke where I can say it to him and it kind of catches him off guard without going too far. It is a workplace here. But I hope you're doing well and having a great day out there. We are financial advisors. We're here to talk about the stock market here today, and I hope you're ready to join us. Now, this Thursday, one of the things we're going to do for clients, every week we do a class called Wine and Wealth. It includes wine and includes talking about wealth. And this week we're going to talk about the Fed now, and we're going to be talking about the digital dollar, the CBDC that's out there. I went through everything, nuts and bolts. We're going to go through and talk about all that. So if you are a client and you are excited, concerned, nervous, conspiracy theorist, whatever you are, I'm not going to share my opinion. I'm just going to go through how they work, what's the process, and what's all going on down there. So I hope you enjoy that and will join us. If you are wanting to play Guess the Dow, jazzwealth.com/Guess the Dow. If you're closest without going over, we'll give you $100. We announced that on Mondays, and yesterday we did announce our winner there. Chose a $100 credit to the account. It was actually Eric's client. So you're welcome to play. Whoa, boy. The stock market here has a lot to focus on, and you can always tell that when the market has little tiny ranges. So, for example, if we come over here, you've got a narrow range day, meaning the difference between the high and the low for the day is very narrow, very close together. It only went up a little, only went down a little, and basically just floated around and did nothing. That's when the market's digesting something. And normally it's pretty obvious. You'd look at maybe the charts, and if you're a technical person, you say the market is digesting prior resistance. It's trying to decide if there's enough buyers that can push it above, or is it going to pull back? What's going to happen? Usually a catalyst takes care of that. But if you're a technical person, that's what you look at. And you say, well, I don't care what the news is. I believe in the charts. If you're someone who looks at the whole market, like I like to do, you're looking at everything and saying, wow, we have inflation to digest here. We have interest rates to digest. We have this technical location. We have, earnings really is a big one there. We've got the debt limit discussions. Maybe getting started, ramping up, whatever it may be, with the sort of bomb they threw out there yesterday from Kevin McCarthy. And you just what do you do? What's the catalyst? What's going to ultimately prove to be correct? I would maintain it's the Fed and inflation at the moment. But for this very, very short-term time in the market, it is earnings. The debt ceiling is what it is. Actually, the worst debt ceiling fight was in 2011. That's when we had our debt downgraded, and the stock market actually sold off on that too. Hopefully this is not going to be the same thing. But earnings is what brings us back to really what drives the market. The short-term blips, COVID, a great example, right? The short-term blips they're sort of day-to-day stuff. Actually, COVID's a bad example. Little news, little events, Fed comments, data points that came out that were better and worse than expected. That's what moves day-to-day. But ultimately, earnings is what drives the market forward. The more earnings that these companies can bring in, the more valuable the stock market is. It's the fundamentals that we look at. And so far, the big banks really are the bulk of who's reported so far. As a whole, they haven't really disappointed. You could see the banks as a whole. We're looking at the large financials here. Obviously, the performance has been good and enough to raise stocks, which raises the sector there. They've been okay. As far as the stock market, it's very early in earnings season here. So We don't have a whole lot of names that have reported, but 90% of those names that have reported so far have beaten on earnings. The average right now at this point in earnings season is 70%, so it's a little bit better than expected. Which brings me to the point, why are companies beating earnings so much so early in earnings season? You know why? It's exactly what we talked about just a couple weeks ago. The bar has been lowered to next to nothing, where it's very easy to beat on earnings. Remember, we talked about that. If it's that you beat earnings by a little bit, well, did you beat your actual earnings or did you beat the lowered bar that analysts said? So, could you just do this? This will be fine. And right now, everybody's just beating the 90%. They're just beating. It's not where we were. So if the bar wasn't lowered, we'd be in bad shape. Remember, I talked about this saying, and I even put it in our notes from Jazz, that the market is setting up for a bullish earnings season. So really cool how they do that and something that, you can focus on there. But the moral of the story is they lowered the bar. If I told you, hey, lift that 100 pounds, and I realize you probably won't, and I said, well, lift this 10 pounds instead, it's impressive if you just kind of lift the 10 pounds. We know you weren't going to lift the 100, right? If you barely lifted the 10. But that's how it works. That's what's going on out there. Really, really kind of fascinating. So let's take a look. With the S&P, we know where we're at. We know we need something to cause buyers to say, I want to participate. I want more. I want to buy this market. Today was not that case. There was no broad participation in the stock market today, meaning you can't say that 7 out of 10 stocks were higher. Maybe you could, maybe like 6 out of 10 stocks. But we had healthcare a little mixed up here, not much going on there. Banks a little bit back and forth. That was kind of Goldman Sachs' fault there. Communication services not really participating, but energy was deciding. Industrial still strong. Basic materials, okay. Utilities not participating. Consumer defensive stocks kind of participating. So there was no real broad excitement to participate in the market today. So where does everybody go? The market was open, right? There must have been something going on. People go to individual stocks. And if you look around the market, you look at the major indices here, the NASDAQ, it's the same thing. There's not much going on here, but NVIDIA, big day for NVIDIA. You look around the market, not much happening here. Tesla, bad day for Tesla, right? Or kind of a bad day. Johnson & Johnson. Let's go over to the Dow here. The Dow was down just a little bit, but with a little bit of a range, not too much going on. Goldman Sachs, that's where the action's at. So you had that sort of short-term day trading activity today, which is not exciting for the investor. It's almost like the market was closed, to be honest with you. Well, the investor sits on their hands. You say, well, I don't know. I don't want to guess that we're going to break above these highs. I don't want to guess that the world's going to just get better all of a sudden. I hope there's a pullback or whatever your belief is. But the traders need something to do. So they go play the individual earnings stocks. And that's the environment that we live in right now when it comes to the stock market. Now, a little bit of a celebratory thing. See this guy over here? So it has been 6 months since we come off of that low. So happy anniversary to the low, though everybody that thought we'd make a new low by now, it just hasn't happened. I guess it could happen, but so far it has not. We were down 25% at that moment from highs. That was a good pullback. It took all year almost for it to happen, but nonetheless, we got down there in October of last year. What's happened since then is there's been 6 months where we have not made a new low, and that made me curious. When a stock market falls 20% or more, does it often go back to that low within 6 months? Or does it just bounce and go? Like, do I want to be bullish or do I want to be nervous about it making a new low? So we went back and looked at this. This is your lesson of the day, by the way. There are 13 other times where the market hit a low after falling 20% or more and then did not make a new low in that 6-month window. It either went sideways, higher, slightly sideways, whatever. It just didn't make a new low. So we said, well, let's take a look at those and see what's happening there. I'm going to start over here, if you don't mind. Here's the forward performance. Now, this is not from the low. So any other study is going to be like, from the low, we did this, right? That's sort of a generic study. This is from the 6-month window. Meaning the stock market's falling, it hits a low, and let's pretend that you said, I don't want to invest in this thing, I don't know. I'm going to wait 6 months and come back and see how things go. From that point, that's where that is right there on the screen. In the dark blue, the sort of highlighted blue we put there, that's where we stand now, from that window to here. If we look here at all the grays and sort of faded in the background, what do we have? For the most part, the market moved higher. There's only one time in history, in 2001, where the market would have ended up lower a year later. Oh. So when we have 20% declines in the market, if you only had this data to go on, would you tell me that a 20+% pullback that ultimately gives you any kind of a bottom there, and we have a 6-month window, would you say that that's a buying opportunity, or it's a reason to run to go be in gold? Is it a reason to be in cash, right? You'd be wrong if you said anything else besides higher, right? You, of course, have your one example. And truthfully, you have another one there where we kind of ended up sideways. But if you're playing the odds of the market and saying, well, I'm not going to go against the trend there, you've got to play for upside there. So if we take a look at this in a little more detail, oh, yeah, you can see it. When this happens, we're past a week, so that doesn't matter. But look at the performance in black. This is the average return after all that happened. So we didn't make a new low. Okay, 6 months have gone by. We're not scared of the market anymore. Maybe you decided to get back in. Okay, over a 3-month time period, 6.85, 8.95 over 6 months, and 15 basically over the course of a year. That's the black line. Now, I always tell you, when someone gives you numbers or stats like that, you want to know, how does that compare to me just staying in the market? Like, let's say I did panic, and over here I said, oh, I don't know if I want to be in the market, but now I'm changed my tune and I want to be back in. Let's just pretend that happened. Would I have been better off just being in the market, or did I do something good in that case? Well, what we're showing here is that any 1-month period in the market is 0.66%. That's the average return. Any 3-month window, right? So if you've just invested for 30 years or whatever, and you went back and looked, you would find that, oh, any 3-month window, I block them all off into 3 months, my average would have been 1.97. If I were to look at my average, a 6-month return over that period, it'd be 4.15. You get that, right? So what we're saying here is, after there's a 20% drop, and we do not make a new low, right? We didn't like bounce a little and then flop back down. That the performance of the market is better than average during that window. So it's beating itself, essentially. The average is just better than normal staying the course. So that's another stat. Think about that. You're out of the market and you know that there's a window of time after a 20% drop where the market moves faster than it normally does. And you chose to go in gold. You chose to go in cash. You chose to sit on the sidelines, whatever you want to call it. That's a tricky time period. That leads me back to, which was just, what was it? We were just covering this here, missing the best few days. So this was the chart from COVID. I kept it. I keep everything. So if you invested before COVID and you didn't do anything, that's where you stand. If you invested before COVID and COVID scared you and you missed the best 5 or 10 days, you have a negative return. And it's because the market had that moment of outperforming itself. It was behaving stronger than it should have after behaving weaker than it should have. So it's very difficult. That's why they say, yeah, it's a roller coaster, right? If you got to be able to ride the roller coaster, you're not going to just enjoy the uphill thing. The fun part's when it goes down and then swings back up again. Everybody loves that part. So anyways, just a little something extra there for you to consider on a Tuesday if you like that sort of thing. Okay, let's take a look at earnings here. Let me go over here. J.B. Hunt in the transport space. Obviously very interesting to see what's going on there. Starting to show some cracks. Just a little bit here. So you can look at these guys, something like this, and say, are they moving more stuff? Because people buy stuff. They don't move stuff that we don't buy, right? Are they moving more stuff or are they not? And if they're moving more stuff, are they able to continue to charge as much as they're charging? No, we're showing some cracks here. They're shipping a little bit less. So they reported their earnings. They go, hey, a little bit weaker earnings than expected, a little bit weaker in total sales. They're shipping less stuff at lower prices. In other words, they're, you know how shipping a box or whatever, transports, they were just having to charge so much about a year ago. That's all starting to come down. Revenue missed by 5%, which hit their earnings by 6%. So they missed expectations by 6%. That bar was already lowered for them, FYI, about 35 days ago. They couldn't meet that. What happens to a stock that can't beat the very little expectation that we set for you? That's not impressive. So you're going to notice when that stocks can't beat their lowered earnings. That's tough. Coinbase getting vocal about their battle with the SEC. They say, you know what, we're going to move out of the country if we don't get some clear crypto regulations. Keep in mind, they're not trying to be bullies about this. I actually agree with what they're doing. I think it's an uphill battle. Best of luck to you. But they're basically saying, you can't come after us and fine us for things when you don't even define the rules. Define the rules. Let's work together on this. Define what rules you're going to have so that we can better sort of compete out there and do it legally. Well, they're in no interest to do that. It's going to be a very long battle because what's happening right now, the U.S. digital dollar, they have very little interest in working on and spending their efforts on this stuff, the regulators, the SEC, the Treasury, and all that. They want to make sure their stuff is straight. That's sadly where they stand. So Coinbase trying to get ahead of it, be a little more vocal, and God bless them. It's going to be a tough one. Bank of America, better than expected earnings, revenues better than expected. They were the beneficiary of people that moved, or one of the beneficiaries of people that took their money from smaller banks and put them in a bigger bank. That's basically it. Saw higher deposits, which means they can make a little bit more money off it. On the flip side of that, Goldman Sachs reports earnings, better than expected earnings. Total sales came in a little bit weaker, and a lot of this was driven by them selling off their Marcus loans. Remember last quarter when we talked about this? They are out of, so the company that they have called Marcus, where you get your Marcus high interest savings account and all that. They wanted to get into, making personal loans and sort of, having a bigger share of your wallet, really, if you wanted to take on some debt. And they've since gotten rid of that. They said, we want nothing to do with that. But the problem is they already made a bunch of loans. So they're basically fire selling off these loans, which has cost them like 400 million, 500 million, somewhere in there. I think I'm really, really close. And so that charge will work itself off for them, and we'll see how that goes. Lockheed Martin getting ahead of things here and breaking out. So looking better than the market, right? If you look at the relative strength, here's one that's bumped its head against all this known resistance, just like the stock market. And earnings today said, there's my catalyst to get me to move above those highs. Better than expected earnings there, and they went as far as to say, going forward, the bar that you've already set for us, we're going to do better than that too. Don't you worry. We're already set to beat that. That gives you a good recipe for a nice little pop there. All right, I will pop out the questions here and see if I can see them and answer them. While I mention that, tonight on our Jazz After Dark, if you want to join us at 7 o'clock tonight, we're going to talk about the data points that you might want to know with your personal finances to really get your dough straight. It occurs to me that a lot of times I'd give ideas and tips and tricks and stuff, but what do we need to know? What's the baseline of what you should know about yourself? And I don't mean budgets and all of that. We're going beyond that. Remember, that's Jazz After Dark is about loosening up a little bit, going a little deeper than we might normally go. So if you want to join us for that, that will be a good time. Be a good time. Market's moving sideways is good, but there'll always be still moving individual companies. Oh, especially during earnings season. Yeah, you'll get your excitement if you're looking for it. So while the market as a whole looks rather sleepy, if you're hunting for excitement, it's kind of like, 11:30 midnight on a Friday night. If you're hunting for some excitement, you can find it. Go far enough. But otherwise, the town is, asleep. What are your thoughts on Fox in light of their settlement? I saw that. I just saw that actually, and haven't looked too much further into that. Settlements are good for companies historically because it means it's a number that we can quantify. We can see the impact now of what it will do to earnings, what it will do going forward. So usually it's a good thing, but I haven't looked much further into it. What's the lowest you've seen the VIX? Well, if you're talking about the ETFs, they reverse split them. So depending on the type of charts, types of charts that you're looking at, it may account for that split. It may not. The VXX has been in single digits before, no problem. And then they just reverse split it. So it doesn't really matter as the days go on. Remember, that's an expensive product. So it has a downward drift to it, even if volatility remains the same. A lot of people don't get that. Got to be careful there. But yeah, single digits are no problem. Actually, you could go back and probably look that up and see. Kirk says he believes that earnings season will be good, but does higher prices and inflation kind of a short-term plus? I'm not sure I understand that question. Short-term plus. I don't know. Thank you, Paul. Interesting deep dive today. Says Michael says Dish made $1.47. Was a dollar. Beat, which took the value 33. Co-founder buying up millions of shares in a deal with $8 people must have in the country to watch TV. Okay. I'm not sure I understand the question there. Slow Joe. So I like that name. My wife started doing that too. And I think we're about in the red about the same amount. From a cash perspective, I think you're pretty much right there. She started growing all kinds of stuff. I'm like, okay. Like, what, we're going to eat it? Well, that one didn't work. We're going to try it again. Oh, all right. And then she gets all excited about something. I'm like, oh, okay, what are we cutting up? Making a nice salad or something? Well, I'm still working. Okay, you keep at it there. Getting ready to update your truck. Sent you an email about it. Yeah, I saw that. I'll be digging into that tonight, actually. I had initially confused myself with some questions on that. But yeah, I like it. And I like that you're not going for, the F or the 2024 F something Lightning or whatever. Being reasonable about that. Of course, they're not cheap. Yeah. Netflix reported after hours too. They're obviously hiding something there if they don't want to deal with their sharing of passwords thing just yet. What it is, I don't know. Greg says, can I withdraw the gains from a sale in a Roth if the sum is less than your lifetime contributions? Well, you may think you're withdrawing the gains, but the IRS is going to count it as your contribution. So remember, it's the first dollar in is the first dollar to come out, FIFO. It is not the other way around. So if your gains are $1,000 and you want to withdraw the gains, you're not going to say that they're the gains. You're going to say, I'm withdrawing that first $1,000 that I put in way back. Yeah, I want that one right there. So therefore, you're not in any trouble. Yeah. Did they stop making the Lightning? Oh, I don't know. Did they, Cody?
I don't think so.
Still making the Lightning out there?
And they still make it.
It's electric now, right?
Yeah, all electric.
Oh.
Hey, did you hear Netflix shuttered their DVD business?
Today's the last day, right?
Crazy. I didn't even know they were still doing that.
I had no idea that they were still doing it. I'm like, who's the one guy that they were like, come on?
That's why I said there's got to be like 3 people that were still using it. Isn't that crazy?
I was a guy back then.
Netflix DVD guy?
I did it DVD, and then I went through a phase where I was like, I'm going to be a person that plays games. And I got all the equipment, I set it up, and then I had Halo, like the original Halo.
Oh, yeah.
And then I was like, this sucks. Like, what am I doing? I don't know what the game's all about. I couldn't figure it out.
That's tough. Yeah. See person, shoot person, I believe is that game, but.
Oh, that's a good one. I was just wandering around aimlessly. Why did he throw that at me? Oh, man. That's how you know your age. That is how Netflix started. They originally would put a DVD, which is how we watch movies, in an envelope and mail it to you. And you would watch it, throw it back in the envelope, and mail it back. That was it. That was how they did that with video games, too, for a little bit. Okay, before we continue to show the age here and such, I'm going to move on and get out of the way. Jazz After Dark here tonight. If you'd like to participate, we are going to have an interesting conversation about the data points that you need to know. If you're not, then I'll wish you a good rest of your evening or day, and we'll see you again tomorrow. Adios.